Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name's Manpreet and welcome to Through the Noise. Now, gold and other precious metals have been quite a big focus in recent weeks. We've obviously had yet another very strong run up, and in more recent days, a fairly significant pullback. And one key question for investors and many investors in this environment is whether this sort of pullback signals, the end of a rally or whether it's yet another buying opportunity. So, that's a big focus for discussion today. And to get more into details on that question in particular, I'm very happy to be joined today by Rajat Bhattacharya, who's a senior investment strategist in the CIO office. So welcome, Rajat. Thanks again for making the time to join today. So let's dive straight into it. I mean, gold has pulled back after what has been a spectacular run-up since August. In your view, how should investors react? Should they be buying or should they be selling?
Hi, Manpreet. Gold has surged more than 60%. In fact, it went above 60% rise from the start of the year until just a few days ago, including a 30% surge since mid-August before this week's pullback. Now, we see the latest pullback as an overdue healthy correction after a record-breaking rally. Now, gold's pullback could continue, of course, near term towards, let's say, the 3950 range. But nevertheless, we are structurally bullish on gold. This is important. We remain structurally bullish on gold given geopolitical uncertainty and concerns about fiscal policy, the concerns about Fed's independence, and the de-dollarization theme that we've been talking about for a while. In fact, we are raising our 3-month and 12-month gold forecasts to 4,300 per ounce for the 3-month and 4,500 per ounce for the 12-month, respectively. Regarding a question about how investors should react to this, we believe it's really an asset allocation decision rather than a buy, hold, sell decision. Investors with low allocation to gold in their portfolios should consider averaging into gold and gold miner equity sectors. For instance, our balanced strategy has a 7% allocation to gold.
Thanks for that perspective. Maybe digging a little bit deeper into what's driving gold itself. In your view, what are the structural drivers of gold today?
Yeah, I mean, gold, as I mentioned, has had a spectacular run, and it has been rising for the 9 consecutive weeks, especially picking up since August. Now, there are a few structural drivers, but the biggest thing I would say is heightened global economic uncertainty. Now, it all started with that freezing of Russian assets by US and EU after the Ukraine war started in early 2022. That was the main structural trigger for gold's rally. Persistently strong gold demand from emerging market central banks, since that decision provides strong foundations for the rally. Now, then came the Trump 2.0, the second Trump administration. The administration's aggressive trade, fiscal, and foreign policies have added to new structural tailwind to gold. US China trade tensions, for instance, are unlikely to fade anytime soon, even if the two sides reach another truce during the proposed Trump Xi Jinping meeting in South Korea later this month. Those tensions really escalated this month after Trump threatened to impose 100% additional tariff on China in response to China's restrictions on rare earth exports. Meanwhile, the expansionary US budget, the so called One Big Beautiful Bill for the new fiscal year, which started early this month, has added to those concerns about US debt sustainability, with US fiscal deficit already running around 6% of GDP while growth remains above trend. And then finally came the questions about Fed independence. If you recall, President Trump fired Fed Governor Lisa Cook on 25th August. And although that decision was subsequently stayed by the court, and that followed persistent pressure on Fed Chair Powell to cut interest rates despite inflation being above target. And that decision to fire Lisa Cook potentially accelerated Gold's the latest rally in August as it raised concerns about the Fed's independence.
Thanks, Rajat, for that sort of overview of structural factors. But what about cyclical factors? Are they having an influence today as well?
Indeed, and there comes the Fed rate decision. So, apart from the structural drivers, gold is getting this fillip from the resumption of Fed rate cuts in September, where, as you know, the Fed resumed its rate cuts last month for the first time this year, as the U.S. job markets looks to be faltering. While the US government shutdown since the start of this month has led to a data vacuum, our alternative data suggests that US job market remains near stall speed, although consumption remains buoyant thanks mainly to the spending from the highest income bracket of the US population. Now, we expect the Fed to cut rates by another 25 basis points next week to 4% to support this flagging job market. Fed rate cuts against still elevated inflation will further push real rates lower, and then that would extend the dollar's decline so far this year. As you know, the dollar has already declined 9% this year, and that could aggravate that due to these structural and cyclical factors. And those combined could further push gold prices higher. And final point, but this is not the it is an important point as well, is that there is rising investor demand. Despite this rally that we saw in gold this year, gold remains under-owned amongst institutional and retail investors. Now, although gold-backed ETF holdings have risen this year, they remain well below their 2022 peaks, suggesting further room for investor flows and ultimately leading to higher gold prices.
All right. I think we've discussed a lot of the drivers or potential drivers of gold, but what about the risks to gold? I guess what should investors be on the watch for?
Yeah, I would say the short term risks are mainly from the price run up. So we do see slowing demand from price sensitive buyers, whether they are households or central banks, and that is a near term headwind. Now, inflation adjusted, gold prices have surged to their highest since at least the 1970s. We have data until then, and that tells us something that gold is indeed very well valued, very highly valued. Now, festive demand for gold jewelry in China heading into the Lunar New Year in early first quarter of next year provides a seasonal tailwind to gold prices. This year, this demand may be more muted now based on what we saw in India's just ended festive season, where we saw weaker volumes. Despite higher value of gold bought, volumes fell reportedly in India as buyers turned more price sensitive. And finally, there is the risk of this US reflation, a hawkish turn in Fed policy due to any acceleration in US growth and or inflation is a big risk to gold prices. Now, US growth remains above trend, and Bloomberg consensus estimates is also showing that US core inflation, for which data will be out soon, stayed elevated at 0.3% month on month in September as tariffs fed into goods prices. So, any hawkish guidance from the Fed next week could see markets lowering expectations of almost 125 basis points of Fed rate cuts over the next 12 months. Now, this could potentially lift the dollar and pull down gold further. Nevertheless, further short term pullbacks in gold below 4,000 per ounce would present opportunities for long term investors to build in allocations, given what I said earlier is that the structural story on gold remains intact.
All right. Well, Thank you, Rajat. I think there are many other topics, obviously, that we'd love to discuss, but I think we're out of time for today. So thank you very much for that gold special, almost so to speak. But I suppose just to summarize the key message for our listeners, a number of things to think about in terms of structural and cyclical drivers as well as the risks. But the broader message is that we still remain constructive on gold prices, where we remain overweight from an asset allocation perspective, and view the current pullback as an opportunity to build exposure where investors may be under-allocated to the precious metal. So thank you, Rajat, for taking the time to join us today, and thank you, listeners, for listening in. We hope you enjoyed the podcast, and we look forward to speaking with you again next week.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.